this conversation. 2019 was the year of the IPO. The notable names, as you so very well know, Uber, Lyft, Slack, Zoom, Beyond Meat, all went public. Some were more successful than others, as I mentioned. Slack took the direct listings route. We'll talk about that a little bit as well. And then, of course, there was WeWork, the IPO that did not happen. And there's been a bit debate about that. So I want to start, if I could, with Mr. Solomon all the way at the end, to try to help us understand what you think happened, what you think changed over the course of this year, because something very well did. And dare I say, and I hope I don't put it in the negative, but I will, how everybody got it so wrong.
Well, good afternoon, everybody. Thank you for having me. And Andrew, I'm delighted to be here with you and also with Stacey and Bill.
Not anymore.
Your premise is, is a very forward premise. I'm not sure that we got it so wrong. There are things that were right and there were things that were wrong. You're talking about IPOs broadly. If you bought a package of all the IPOs that came to market in 2019, I think you returned 34%. You outperformed the broad market by a little bit. So, I don't think we got it wrong. There are deals that did not perform well. There are companies that didn't meet the expectations that were set in an environment where the expectations for certain companies have been set very aggressively. But I don't think we got it wrong. If you're looking for what may have changed during 2019, one of the things I've worried about and I've talked publicly about, quite a bit over the course of the last couple of years is in an environment where for a long sustainable period of time, interest rates have been zero and money's basically been free, it pushes people out the risk curve. And one of the consequences of that is people chase growth. And people start to overvalue growth and undervalue the future value of earnings that a company may provide. And in the long run, I'm a big believer that companies over time will be worth the future value of the earnings that they provide. Now, there are all sorts of windows and timing in the middle of that, but I think we've seen a little bit of a rebalancing where the need to really think about a path to profitability is coming more sharply into focus than it might have been 18 months ago.
Okay, let me just follow up then on this. Mm-hmm. And I do think I'm thinking about the Lyfts of the world and the Ubers of the world, and frankly, WeWork, which didn't go public, and so you could argue there was maybe some discipline in the market, but at the same time, the banks, including Goldman and others, were valuing them at a significantly higher number than they ultimately are today. What do you think happened there?
Well, there are a whole bunch of things in that, and if you want to point to that one specific example, one of the things that I think that I've said publicly, so I'm not saying something I haven't said publicly before, is the process actually worked around WeWork. And this commentary that the banks were valuing, the banks weren't valuing. The way the process of an IPO works, when you're a bank, is you're invited in by a company, it's a private company, their numbers aren't public, they give you a model. You say to the company, well, if you can prove to us that the model actually does what this does, then it's possible this company could be worth this in the public markets. Depending on how the company works, that information starts filtering out into the world. But ultimately then there's a diligence process, there's a proving out process. There at times are meetings with investors beforehand, and that process grounds to reality. And ultimately reality then gets executed on one way or another. And so, I think that's a great example of the process working. And it might not have been as pretty as everybody would like it to be. Everybody might like it if that all happens behind the scenes and it's not as visible, but in the world we live in today, that's the way the world is.
Okay, final follow-up on this particular issue. Do you believe that any of these companies, including WeWork, ever misrepresented either their numbers or their model to you?
I'm not going to answer that in the context of the way you expressed it, but I do think there's an issue that you're touching on that I assume that the three of us will get to, which is, if you go back, when you think about IPOs and capital formation and venture capital, and Bill could wax on about this for a long time, venture capital years ago really was a very, very narrow slice of the capital markets. Very wealthy individuals gave money to stewards of that capital to start businesses, because in starting business, that was a very, very risky thing. And so the theory was those people could afford to take a lot of risk and lose, and maybe across portfolio theory, they'd make money. And when a company needed capital to grow, once it got past that initial funding stage, the only place where it could go get capital was in the public markets. So companies had to go to the public markets at a much earlier, smaller stage. and therefore go through the process of discipline around their statements, their information, et cetera, at an earlier stage. As the capital markets have allowed for more private capital formation, much more broadly, that's shifted. And so you now have companies that have thousands of investors are raising billions of dollars of capital, and they are not held to the same standard around producing information on their performance. They're not held to the same standard around statements they make about how their business is or is not doing. And that's an issue. And it's an issue because whether investors do or don't rely on it, employees relying on it when they join, and part of their compensation is in the form of stock, they're relying on some of those representations. So that's an issue that probably deserves a little more attention.
Well, let me ask Stacey then to speak to that very issue, because one of the things that the New York Stock Exchange and NASDAQ and so many others, frankly, have pushed for several years was to make it easier for companies to go public. And as part of going public in that regard, to actually make disclosure less transparent, not more, because there was a view that more transparency was actually encumbering startup companies from making the leap to being public.
Okay, I'm just going to start with one. I'm also thankful to be here, and two, I had a hard time not cheering, David, when you were running through all of those things, because I really do think the public markets do introduce discipline and governance that are so critical, and disclosures are a big part of that, and that transparency is really important. Where you've seen us push back on some of the restrictions are when they're not about investor confidence, investor protections. So I think financial protections are really important, and then we just want to strike that balance between investor protections, investor access to information, and issuer flexibility. Because if companies ultimately end up staying private, then investors don't have access to those opportunities at all. And so we don't want to skew the market too much that way. And that's what we're seeing, right? A lot of these large companies are larger because they're twice as big when they're coming public as they were before. And now if you have a founder CEO and a company that potentially didn't have good habits in the private market space, those habits have grown with them. And now we're starting to get into real governance issues. And you do have a lot of fear of missing out, right? If you look back and trying to tap into that growth, investors were ignoring what was happening because they didn't want to miss the opportunity. They didn't want to miss the next big thing. And so, in many ways, they were investing even when perhaps they should have been asking some of the tough questions that they are now asking. And so I do think that we are in a different norm now, where investors are starting to ask a little bit more questions about profitability. And the IPO market did do well in 2019. There are a handful of companies that didn't. And you can look and you can see what the differences were. And when companies weren't rewarded by the public markets, it was when they didn't have the clear story about how they were going to be profitable.
Bill, has it benefited these companies to stay private as long as they have? Or has that actually underlying this one of the big issues?
Well, I think yes and no. I think there's a lot of things you can do as a company while you're private. And I agree exactly what David said, is that companies now have that opportunity because scale capital is available. When I started in the early 90s, you had to go very quickly to the IPO market to raise any kind of meaningful capital, $100 million plus. But now growth capital is available at scale. And there are some things you can do: perfecting your business model, strengthening your management team, allocating management's full attention to developing the business, instead of the 10 to 20% that's required once it goes public. So there's a lot of good to being private, and it's why there's 8,000 private equity-backed companies today. On the other hand, I think David and Stacey, you're right. We lost our way a bit last year and the last few years around some key disciplines. I mean, disciplines around business model, about capital utilization, about governance, and these are all, we're a place that got out of whack. And something I've been saying is that usually it was the private market that governed an overvalued public market. This time it was the public market governing an overvalued private market for the first time and saying this is just not acceptable to us as a public investor. And I think it was actually a very healthy process and puts us in a much better place for both private capital as well as public capital.
I imagine you're not going to want to play the blame game, but let me throw out an idea. One of the things that took place over the last 3 years that may have made this as unhealthy, some of the issues that you just talked about, is the introduction of SoftBank and Masasan to these businesses and the idea of growth to some degree at all costs. What do you make of that idea, and what his personal involvement in the growth of this space has meant to all of your businesses?
Well, I'll start and Stacey jump in, but You know, if you look at private equity capital raising, there's a 1.5 trillion of uninvested private equity, but the fastest growing segment has been growth equity, and there's been $500 billion raised in the last 5 years for growth companies. So that money was looking to get to work, as Stacy said before, and I think that's was a very, very big factor in the market losing its discipline. SoftBank would just be one example, I think, of other places that really did pursue growth at all costs. And one of the things that we really objected to in terms of some places where we were invested together was they were really pushing companies to globalize so quickly, even before they perfected their business model in one geography, let's say. And we were saying, let's get the model right. Let's get the path to profitability. Let's get the unit economics working. And then we can think about expansion and growth. But instead it was, no, we've got to go to China now. And we've got the capital to do it. And I think that caused the market to lose its way.
I don't think you can look at the valuations in the private markets that are based on one investor and then use that as a proxy for, hey, this is how this company is valued, because it's really one opinion. And you don't get real valuation until you have many buyers and sellers coming together, which is what the public markets deliver. And I think it is a very concerning trend, especially if you have a very high-profile investor who is valuing companies differently than the broader market would, because it is becoming a reference point for the market. And now we do have retail investment in the private space through large institutional investors without the disclosures and transparency and actual valuation. So I think when you look at the fact that companies are staying private longer because they have access to private capital, traditionally it was the need for capital that drove companies to the public markets much earlier in their life cycle. Now it's very different reasons that are driving them to the public markets, because usually they get money.
So
Time, though, Andrew.
Yeah.
Time perspective matters. And so, Square. I think the last private round was at $6 billion. The company went public at $3 billion. The investors who invested at $6 billion, if they really believed in the company and they were long-term investors, have crushed it because the company's worth $30 billion. What this is supposed to be about is picking good companies with good business models that make sense, that can grow and scale and get capital allocated to them, and then being a long-term investor. Unfortunately, I think a lot of the dialogue gets sidetracked around that with a much, much shorter perspective.
let me ask you a policy question then. One of the things that has happened, as Stacey just